Hey there, it is John Downs here, and thanks again for joining me on my weekly update. This is Friday, May 3rd, and I have to tell you, it's been a wild last 2 weeks. If I go back about 2 weeks ago, there was a fair amount of fear building just generally in markets. We had the stock market crashing between 5 and 7, 8%, depending on the indice. You had fears of war escalating, right? The Iran-Israel situation. You had mortgage rates that just continued to go up. There were fears of what you call stagflation. I'll touch on that in a second. And then a byproduct of all of that wound up being a little bit of fear in real estate and in markets. And you started seeing inventory reports showing inventory rising, national headlines starting to look a bit negative. But then fast forward to today, we have interest rates appearing to have topped and starting to rally. You've had stocks that virtually completely rebounded, still a few percent off the all-time high, but rocketed higher. It had a slew of corporate earnings come out. Now, there's stories within those earnings. We've had some economic reports. Again, if you dig into the details, there are some hot spots and there are some that could be a little worrisome. And then we had the Fed meeting this Wednesday, where the Fed pretty much came out and they actually calmed the market down. I think a lot of people went from 6 rate cuts at the end of 2023, meaning this year, 2024, we'll see 6 quarter-point rate cuts, 1.5%. And that was kind of the rally from October to the end of the year. And then as we kind of got started this year, we had economic reports showing strength-ish, right? Things that were good, not great, but good. You had inflation reports that were dropping, but not really dropping like we wanted them to drop. And then even plateauing and picking up a little bit over the last month or so. And that started making people think, well, maybe the Fed's not going to cut as much. Then it went from 6 cuts to 3 cuts to 2 cuts to maybe no cuts to possibly raising to then now we're pricing in 1 or 2 cuts. So the point to all of this is the market seems to try to trade on the predictions of the future, but the predictions of the future, the Fed said, are based on data. The data that comes out, it's a little bit lagging, but we generally will get it every single month, and then they're going to make some decisions. So in this report, I want to just go over a couple things. We'll talk a little bit about rates and trends. I want to dive into just markets in general. What have we been experiencing over the last week or so? And then I want to talk about housing data, because the housing data is interesting. I think it's very important, especially as national headlines and narratives, they generally will look at big global numbers, right? The entire country instead of maybe more regional. So we're going to touch on that a little as well. Now, this headline right here pretty much sets the stage for what the market has been feeling over the last few months. Stagflation. So sort of an economy that's stagnating, but yet an undertone of inflation staying hot. That's like the worst of every possible scenario you can have, really as an economy, but certainly as the head of the Fed, right? Because if you try to crush inflation, that means you generally will have to raise rates. Well, then you're actually going to hurt the economy, which is already showing signs of stagnating. And by stagnating, I'm referring to job cuts. If we just look at the real underlying data, you'll start seeing that planned layoffs. This is from Macro Edge. You should check them out on Twitter. They have a lot of daily updates on corporate layoffs. And we actually had the most number of layoffs in the month of April than we've had in quite some time. Another report would be the JOLTS report that came out this week, which shows how many job openings are there. What is the direction of that? Now, no one ever really paid attention to this report until all of a sudden the Fed highlighted it about 1.5 years ago. They were like, wow, just look at how strong the job market is. There's a lot of job openings that people can't fill. And of course, the unemployment rate was pretty low along with that. So they've been keeping an eye on this, and you can start seeing it just falling off a cliff all of a sudden. Which then leads us to the April jobs report that just came out, showing only 175,000 jobs. Now, while that still shows an increase, we did see an uptick in the unemployment rate. And when you really peel into all the data, sort of digging through the entire report, you find glaring soft spots in the economy as it relates to jobs. But one thing the Fed saw today that they did like was the average hourly earnings actually continuing to decrease. Now, it seems weird for all of us to celebrate the idea that maybe people are losing their jobs and there are fewer jobs available. and people, they're not getting raises like they used to. But it's all part of the cycle that the Fed's been trying to control for the last 2 years while they pushed interest rates so high. If you don't really understand why this process has been taking so long, I'm going to go ahead and link the video here for you that I did to just why the Fed hasn't broken the economy yet. Why has it taken so long this time for the effects of Fed tightening to roll through the economy? Now let's dive in and look at interest rates. I'm obviously in the mortgage and real estate world. Interest rates are really important, right? It is the direct component tied to affordability. Affordability is what lets people buy houses, right? So they can afford it. But more importantly, it's for people that currently own a house that might want to move, that feel trapped. They feel stuck. They can't do it because the new payment is just too big, right? So if we look right here, you'll see a nice little drop off over the last 2 to 3 days. Now that is a combination of the Fed meeting, the jobs report, some of the other things we just discussed, all coming out Wednesday, Thursday, and Friday this week. But I want to again point out this point right here was mid-October. From mid-October to the end of December, we wound up improving 1.5%. And that was essentially the market pricing in Fed cuts. And then we've jumped all the way from 3.75 up to 4.75. We gave 1% of that back to start the year. Now we're just 0.25% off the highs. Now the question is, where do we go from here? So a lot of times we in our world, we talk about tech trading, where maybe you sort of look at these trends, and what you can see is we bounced right off of an uptrend right there. So does that mean we're just going to do what we did back here and keep climbing this channel? Or eventually what winds up happening, here I can just move this over here, you wind up breaking the trend. And then, of course, you go all the way down into further improvement. Now, the Fed made it pretty clear they're looking at data moving forward. Every report is going to be important. And what I would say right now is most every report is showing more signs of weakness than strength, except for the inflation components, which is what the Fed cares about the most, right? So you might have a manufacturing report showing contraction or a PMI report. So measures of business activity actually looking recessionary, but then within it, the prices paid for companies or wage components, how much people are making, those can actually go up at the same time that the actual product and service is going down. So it's not really the combination that the Fed wants to see. So moving forward, every report's going to be important, and every report might have a more meaningful swing in interest rates than it did before. For instance, if all of a sudden this week we came out with a pretty strong jobs report, I think where rates were Wednesday, the market would say, yeah, that's why rates have been moving. We knew this was going to happen. So now that we've rallied just a little, still very close to the yearly highs, if we wind up getting some reports that look glaringly positive for the Fed, which might not be fantastic for the economy, then all of a sudden you'll see interest rates improve. Now, what's interesting is the stock market then rallied on this news. If we go ahead and take a look at this. This chart right here is the S&P 500, and you can see kind of at the, April 15th is when just things started getting crazy. Rates started driving up, war with Israel, Iran, and just a lot of things starting to scare people. Inflation readings coming in hot, and the stock market pulled back 5 to 7%. And then since then, you see these massive gyrations, just a 2% move up, 2% move down, right? Another 2% move up. So that kind of behavior, that erratic trading, it's sometimes a sign of more uncertainty and potential top. Now, in the past, when they say that the first rate cut or thoughts of rate cuts causes markets to rally, because the idea is this soft landing scenario might actually play out. But then when you dig deeper and you realize why the Fed's actually cutting, you might see that the economy is slowing down too fast. Now, in 2019, the Fed really did exactly what they're doing right now. So Wednesday, they came out and they said, you know what, we're doing this quantitative tightening thing. And that's basically that when bonds roll off their books, the bonds that they bought from a few years ago, or geez, even 10 years ago, when those roll off, right? Think of people refinancing their house, which no one's doing, or someone that actually sells their house that they refinance. That's happening a lot. Those loans, when they sell and pay off to zero, the Fed would usually take some of that money and go buy more bonds. Well, instead, they went through this quantitative tightening where they said, yeah, we're not going to do that anymore, right? That's what we've been dealing with for the last year or so. Well, they came out Wednesday and said, you know what, we're actually going to pull that back. I think it was 35 billion or so less per month. And then they said the reinvestments that they do have ongoing, they're going to buy treasuries instead of mortgages. Don't believe that that starts until June. But if you have less money coming into the mortgage market buying mortgage bonds, that might not be great for rates. But at the same time, in 2019, they did something very similar. That was the first sign where the Fed was like, I wonder if we're doing a little too much here. I wonder if we've kept rates a little too high for too long. The data's starting to look a little mixed. We still feel good about it, but it's starting to soften. But then all of a sudden in late 2019, they had, I think it was a 0.5% cut, and then they stopped all the quantitative tightening. That was their like, oh shit, we did stay on this for too long. We need to unwind some stuff pretty quick so the economy doesn't fall off a cliff, right? Because they also don't want to crash the economy. We do have an election year. I think there's always going to be some bias in action, knowing what we're going through right now. I'm still sort of in the camp that the underlying economy is probably more fragile than people think. I also believe then that the mortgage rates probably trend a little bit lower, either from spreads tightening or just general weakness bidding up bonds. But I'm also in the DC metro area where we are fortunate that a lot of the deficit spending that everyone out there watching this helps pay for flows into my market, right? So government, defense. We also have a pretty big tech sector here in the DC metro region, as well as healthcare and big law. So the diversity of the economy is actually doing really well. So I think national weakness, while that might impact interest rates, maybe stock portfolio values, things like that, I don't think it negatively impacts our local economy and therefore housing quite so much. Now let's just look at a few more things this week. It's just been so wild. This is the Amazon. So they came out with earnings and you'll see they've been pulling a lot lower, obviously with the general market trend. And then boom, earnings and low rates and Fed, and it just skyrocketed. And then you had Tesla did the same thing. They bottomed at about 140 and went almost to 200. That's like close to a 50% gain, like hundreds of billions of dollars of a stock going up. I didn't put Donald or DJT or whatever, but that's another wild stock that keeps trading like bananas. And it makes you wonder, are we at that greed phase of markets where everyone drives it up and then shorts it down and then drives it up? So it always is a sign for me of, hey, just be more cautious. And then you also had Apple. They did anything really new that is fantastic in 5 to 7, 8 years. Yet they came out and said, hey, we have all this cash. We're going to buy up our stock. We can't innovate. So why don't we just buy our shares back? And the stock popped. Like this is almost a $3 trillion company that jumped, geez, what's that? Almost 10%. That's like $300 billion in just a couple weeks. It's insane. Like these moves are just wild. But then you have the opposite of that, which was Facebook. So they came out and they just got absolutely murdered. They went from like 500 down to 400. I think it was a 15 or 20% drop pretty quickly. And then my favorite, I've never been a Starbucks fan. I think they just rip people off for just awful drinks, either too much sugar or just not enough taste. And this actually I enjoyed seeing where they fell off a cliff. But the point I want to make here is if there's ever a primary consumer facing company that represents middle America, I think it's probably Starbucks. When things start wearing on you, either your credit card balances or a little bit of fear or something, you're like, you know what, I'm just going to skip that $8 coffee. And that apparently is what is going on, not only here in the US, but around the world. And then Amy Nixon, she's one of my favorites on Twitter, great real estate analyst, definitely does not like Airbnbs and short-term rentals, but she has a really good philosophy and she's been early on how that's going to impact real estate throughout the country. But I thought this meme that she posted was fantastic, right? It said boomers, they're like, stop drinking Starbucks if you want to save up and buy a house, right? You're wasting money. It's everything I just said. And then the end was millennials, like, okay. Now I'm a father of 2 and I can tell you my kids never do that. They never just say, okay. ever, usually. In fact, they would probably go buy more Starbucks. They're watching this, I'm sure. So let's just carry through to some housing data. And I think this is important because you're going to get a lot of headlines coming up, mostly national, and they're going to say, wow, look, inventory is at its highest level in 4 years. And they're going to show all these charts and percentages that in a lot of cases could make you think, ooh, this isn't good. Like that, this is not something I want to see, because higher inventory might ultimately mean lower prices. And you'll also see other things about price decreases on the rise. Now, before I get into the next slides, know that in the description, I have all of my Altos reports for regions, as well as a few of the primary counties of the markets that I serve. And there's actually a toggle button where you can actually look at price decreases. And what's important about this chart is that it gives you a 5-year look back. So you can see the seasonality, like what is normal? Because I think for you to say something is higher, it needs to be higher than something you're comparing it to, right? Some other point in time. But if you check out this chart, you'll see, yes, we have more inventory today than the last few years, which were arguably the lowest of all, low, but clearly lower than prior years. And speaking of national data, I think this is important because when you hear of a headline, inventory up 17% year over year, that they're taking every single house in the United States and they're comparing it to every single house in the United States a year ago. Whereas if you really drill down into local areas, you can actually see that there's excess inventory building in some markets where others are relatively stable. Like look at the entire mid-Atlantic, sort of Northeast mid-Atlantic, that's my market. We're in the teens. Like we went from the worst of the worst ever, and we're just a smidge over that. And some would argue that a lot of the houses that represent this new inventory, that they're actually not awesome houses, that maybe the inventory that we're seeing are maybe just some older beat up places that need some work. So something just to think about as far as how these. Now, Amy Nixon would say that there's a lot of short-term rental stress in some of these real dark markets, either high investor concentration or high short-term rental concentration, which I actually do believe is a big factor. Now I'm going to dive into just my local market, DC Metro. When I sort of segment both of my markets, there's the Baltimore market and the DC market, all the counties that sort of touch the two primary cities. And what I notice is just almost identical similarities. Actually, it's a little bit worse off in the Baltimore market, meaning lower inventory. So I'm just going to use DC as the example. I'm just going to use the region. Again, you can click below and look up the individual reports that you'd like to see. But check out this active inventory and you'll see, yes, a little bit more inventory here in 2024, fractionally. What are we, maybe 500 units or so off of only about 3,000. But what's interesting is when you start adding prior years. So let's just take a look at adding 2019 and just look at that gap. It is just massive. It's about 5,000 units of inventory that is out of the market. And then if you add 2018, even more inventory. 2017, even more inventory. So, you know, we have an inventory crisis at the moment. I don't see it getting better for a little while. I'm going to link the video that I did on why inventory is stuck. I think it's very important to understand how every market is going to be very different than the other, but there is a very compelling reasons why housing is stuck right now, and then what it's going to take to get it unstuck. We need wages to go up for a period of time. Right? So if someone has, actually, if you look at this next slide, you'll see it shows the effective mortgage rate within certain states. So all the mortgages, you divide the balances, you know, kind of blend it out with the interest rates, and you can see where people are. In my markets, predominantly on the lower side, 3.9%. Loans are bigger. They refinance a little faster. The closing costs to do refinances are relatively very, very inexpensive. So again, just easier to refinance. And that's why I think those rates are so low. And for people to move, they need to afford the new payment, right? So number one, houses are more expensive and then interest rates are a lot higher. So if they have a $3,000 mortgage, they have to be comfortable going to a $7,000 mortgage. So what allows them to do that? Well, one is tax savings. I've linked a video here. You can kind of dig into that. I still need to do the one for move-up buyers, but it's a very similar concept. Most people right now that refinanced during 2020 and 21, they're actually not getting a mortgage interest tax savings right now, especially if they're married, because the rates were so low that they're just not paying any interest. So that's a very important thing. But also you need wages to go up, and they have been. So a lot of these people that especially bought in 2018 and refinanced in 2021, they might be making 30, 40% more than they were making back then. And their asset values have gone up. Think 401k balances or any of their stocks and investments. You have money coming from family downstream. A lot of things at play that actually make it easier for people to step into these bigger, higher mortgage payments. But we also would like to think that if interest rates relax, that also helps unlock the entire process. And I think this chart's pretty wild. This is from Resi Club, where they actually had the FHFA estimated, some of their researchers, how many units, how many housing unit sales transactions have not happened as a result of the rate lock-in effect, what I just showed you, the inability to move up and grab a bigger payment, or just not wanting to do it, right? So a lot of people can afford it. They're just like, no, it's crazy. I'm not going to do it. This house, I'm just going to grind it out and make it work for longer. That's what a lot of people do. In my market, 76,000 fewer units. Just to think about, here we are talking about 3,000 units of active inventory in the entire DC metro area. And we're talking about tens of thousands of fewer sales as a result of that low inventory. It really is wild. And that's all I have for you this week. I will say that the energy right now in real estate still is very high. Despite that last little run up that we wound up seeing in interest rates locally, if we measure credit pulls as the ultimate sort of forward leading indicator of buyer demand, how many people want to buy a house, credit pulls are actually very, very high right now. It shows that the activity is still there. Now, I think a lot of people are still in the process of evaluating what payments are comfortable and then backing into appropriate sale prices. But as interest rates go a little lower, if that trend continues, which I think it's more probable than not, I think that probably puts a very, very, very solid floor in housing. I think that story that a lot of people say that, oh, low rates are going to bring all the people in. I don't know if it brings more in. I do think it unlocks people. I think it creates action. I think what it does more than anything is it takes the buyers that are in the market and maybe makes them just a little bit more aggressive on the houses that they see. So maybe that means more competition, maybe not a flood of people, because let's face it, payments are still pretty high. Housing is somewhat of a luxury asset for a lot of people in a lot of markets right now. So if you have any questions about anything I went over, please drop the comments below, and I hope to see you next week in our market update. Have a great weekend.